Starbucks reporting better than expected earnings and revenue, but same-store sales declined for the fourth straight quarter. Joining us now, Citi restaurant analyst Jon Tower. Jon, thank you for being here. So this was the first quarter under the new CEO, Brian Niccol. How do you think he's doing?
He's doing well. I mean, considering the task ahead of him, it's going to take a long time to get this business going in the proper direction again, both in the U.S. and across the globe. And there's signs and evidence that it's working in terms of getting some sales progression in the U.S. and customer satisfaction higher, and importantly, employee engagement and employee satisfaction higher. So there's signs of progress. It still looks like it's going to take a long time to kind of normalize. And importantly, it's going to cost a lot of money. And I think that's kind of the key message from last night is they haven't settled on the exact amount it's going to cost across the different pieces of their business, but it's going to cost a lot.
Yeah. And do you think investors have patience for this? Because, you know, as you mentioned, the turnaround will take time. It will be costly. Do you risk kind of losing the attention of investors who have been kind of through this volatility over the last few years?
As long as he continues to deliver upon his promises, which include, you know, getting the average transaction down to about 4 minutes or less in the U.S., you know, and doesn't disrupt, frankly, the labor model too much for the employees, I do think that investors will have some patience here. But look, as we've seen in the past across the whole landscape of restaurants, as long as sales are progressing in the right direction, then investors will give them time. When and if sales begin to, you know, stumble a little bit, whether within their control or outside of their control, there will be bigger questions, and that's when the stock likely begins to come under a little bit of pressure.
What do you think they should do with the business in China? And do you think the best capital optimization is maintaining that presence there?
It's a great question. We've done some work behind it. It doesn't look like there's going to be a ton of value creation if they were to say, go license it or turn it into a joint venture. All that being said, it likely makes a lot of sense for them to focus the majority of their energy and capital on the U.S. and perhaps other markets that we're not quite aware of today that might provide greater opportunity over the long term. The volatility in that market and frankly, the competitive intrusion over the past 5+ years has really diminished, at least from the outside, what appears to be the opportunity for the brand in that market over the next several years. And I don't think investors really want to hang on for that ride using company capital. They'd much rather have a joint venture model or some sort of licensed agreement in that market such that, you know, you're just clipping cash flow rather than having to deal with the ongoing EBIT swings.
Yeah, not to mention the geopolitical implications of, you know, potential
Right.
tariffs and retaliatory tariffs and,
Exactly.
you know, the degradation of American brands that are kind of going through those trade spats if that ultimately comes to fruition. But speaking of tariff squabbles, we did see a very brief spat with Colombia over the weekend. Longer term, though, are you concerned that the trade relations worldwide could lead to higher coffee prices that could cut into the margins of Starbucks? Is that something that you've been studying and are concerned about as you model out this company?
Yeah, look, they spoke last night to the current impact from coffee prices, and they have a decent amount of inventory, at least to work their way through the fiscal second quarter here. They said it was going to be about a roughly penny headwind to their earnings right now. Beyond that, it's a bit of an open question mark. It's not a huge piece of the puzzle, at least from the store level operations. However, they also have coffee in the grocery aisle, and that's probably where consumers are going to see it the most. They have partnerships there, and they're likely going to pass along pricing. They're expecting in that case that volumes in the grocery channel are likely going to fall for them as that pricing goes through. Beyond that, some work we did going into this quarter suggested that the current rise in C prices was something like a $190 million headwind to their EBIT over the next 12 months. They wouldn't bless that last night, but it does seem like it's going to be a pressure. And the company's committed to holding the line on pricing at their stores for fiscal 25. So it's going to be a bit of a balancing act from a profitability standpoint if they stick to their guns of holding to no pricing in 25. And what that even again means for fiscal 26, because zooming out, one of our takes is that the pricing and the affordability for the average consumer has been an issue here for the brand. And if you have to take pricing again in the next 12 months or so to offset some of this inflation, that's likely sending the wrong signal to the consumer.